We know that rapid globalization of our economy has increased the frequency and the spread of such incidents by generating a ripple effect which has exposed the fragility of our financial system, and it's becoming increasingly clear that the effects of the initial subprime crisis are spreading across other global markets. No one, it seems, is immune, and although the European Union held out against the economic woes on the other side of the Atlantic for much of last year, with the euro hitting unprecedented highs against the dollar, early indicators for this year show that growth is slowing and may be going into reverse.
There are many financial institutions throughout the world who will be in some difficulties today if it was not for the much-needed capital injections made by certain sovereign funds. In Europe, we've had traditionally an open response to inward investment, and this will continue. We've already a comprehensive legal framework in place that provides for inward and cross-border investment, including sovereign wealth funds. This is a predictable framework based on the principle of free movement of capital. There are, of course, treaty provisions that allow for restrictions to be put in place, if needed, to provide for objectives such as national security, public order, or overriding objectives of public interest.
The current crisis, in my opinion, does resemble previous crises, but also has its own specificity, which is underlined by the magnitude of cross-border operations, the opacity of a large chunk of financial markets, and the inability of supervisors and regulators to react properly. Cyclical factors, I will touch very lightly upon it. It's the excessively low risk-free interest rates at all maturities in major economies, the increasing gap between high returns on capital and the low cost of capital.
As soon as big borrowers or big banks are threatened with bankruptcy, they are being bailed out, either by the IMF, by central banks, by governments, whatever. This is so far done, and it's normal that it is being done because their bankruptcies would have created havoc. But the problem is that all this is done free. It's a kind of free subsidy for the financial system. There is no cost in insuring against the systemic risk. I think that is also a problem. The problem of the quantitative models has been mentioned. These quantitative models, first of all, they have flows, but secondly, they should not be used to create the impression that risk can be summarized in one single figure.
We do have a code of conduct. It's public. We do report on it. This code is driven by a set of international standards. And there's some key elements in that code to manage the conflicts that we face. And we're not in denial. There are conflicts in our business model. We need to manage them properly. I just want to raise one or two of them. First is that when we take a rating action, that is not one analyst taking that action. We take action through rating committees. It is a majority vote in that committee. The lead analyst will bring the credit to the committee, present his analysis, and that committee will have a range of staff from the agency.
I would caution against the complacent view that this is a subprime crisis. In fact, this is not a subprime crisis. This is a debt crisis, a North Atlantic debt crisis. It is not confined to the subprime mortgage sector in the United States. It is the beginning. That's where the crisis started out. But we've since seen the crisis spreading to many other segments of the market. Paul Krugman once said that every week a sector of the financial market is falling into crisis that he didn't even know existed 2 weeks ago. And frankly, you know, who had heard of monoline 6 months ago? I haven't, and I write columns about them now. And you know, there are term auction facilities which are in the news. They are very complicated parts of the financial markets.
I think that you can perfectly have liberalization with an appropriate and adequate level of regulation. It doesn't necessarily mean deregulation. In fact, here in the European Union, we've seen the Financial Services Action Plan that has been introduced and that has brought about a considerable amount of regulation, trying to achieve the necessary liberalization within the internal market, taking that into context of its global role as well. I think what we should be looking at, and the previous speaker is intimated that as well, it's perhaps the quality of the regulation that is at stake.
This present global contagion is different from previous ones for a number of reasons. Firstly, it is by far the largest such event. It's multi-dimensional and it's still unfolding. We also know, Madam Chairman, that it took root and developed within the single most prescriptive regulatory regime in advanced monetized economies. We know that it was and is still being transmitted across continents despite Basel II.
I don't see subprime mortgages as being a bad thing in themselves. Talking about the social dimension, I think it's a very desirable thing that we can provide funding in some form or another for those who are less advantaged, for the young, for the first-time buyer, for the person who wants to get started on the ladder of owning their own home. I don't see necessarily that securitization is such an awful thing. I agree with my colleague on the right there that it has its place. It has a very important place in providing for the funding of the financial markets.
You can see that the ECB was one of the few actors, I would say, from the public side who was able to intervene rather quickly and effectively with the oversight the ECB has. But also there, this oversight is limited because it's the monetary authority and it's only part of the picture, and it didn't have the macro-prudential oversight of the big players.
Not one central bank economic forecasting model allows for multiple interest rates, i.e. difference between repo rate and money market rates, the pass-through problem, the fact that if you alter market rates, you do not necessarily alter mortgage rates, and credit rationing. So we've had a position actually where intellectually central banks have been seeing it as well. I'm now going to say a few quick words on Northern Rock. What happened, I'd actually given a lecture in Oxford. I'd had quite a long journey. I got home, I sat down on my settee, saw the words Northern Rock on the television. I said to my wife, one thing I've learned from equitable life is you get out of the first sign of trouble. It's an internet account. We had the money out within 15 minutes.
So the only adequate response to the crisis will be a collective one. We're all in this together. The good news is that we know the list of issues that we each need to work on. Public and private sector are already hard at work, and the deadlines are tight. We must be coordinated, and we must cooperate. The second point I'd like to make is just a list of 3 key considerations I think we must not forget as we go through all this work and try to respond to the crisis. The first one is we must not throw the baby with the bathwater. The securitization has been good for our economy.
Our experience is that appropriate preventive policy making requires strengthening the role of the national supervisors by statutorily ensuring their role with respect to financial stability. Second, this requires necessary amendments in the legislation enhancing full operational independence as well as clear and precise mandate.
I try to structure my few remarks around 3 headings. One is assume responsibility, 2 is ensure transparency, and 3 is add to stability. And when I talk about responsibility, I must say I am a little bit surprised by the reaction that I've seen so far by the banks, because after all, it is the banks where the whole development started.